Welcome to the Gray Report, fellow multifamily investors, market junkies, anyone that's trying to, understand what's going on in the commercial real estate market. Again, active, passive. Maybe you're in the industry. We've got a really great episode today. Going to be looking into some of the trends to look out for as we approach the new year, 2024. So whether you are watching this during Christmas holiday season or just after the new year, you can kind of get some insights on what to expect as the next 12 months unroll and what surprises they may have in store. Well, we don't know, but we're going to try to take some educated guesses, look at some pieces, some really smart outlets most of the time, as well as some of our own, I don't want to call them necessarily predictions, but I guess, again, educated insights of what the new year may bring. All right, let's get into it. All right, bringing it in. Welcome back to the Gray Report, joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital in the Gray Capital Studios in Frosty, Indianapolis, Indiana. Yeah. Matt, we are on the precipice of not only Christmas, I believe the end of Hanukkah, but also the New Year, all kinds of great holidays, Boxing Day, Kwanzaa, etc. Everyone's putting out articles on what to look out for in 2024, predictions, trends. I put my own list together. It's not really completed yet, but I shared around the office just some things to be looking out for. A couple different categories, but also some pieces from CBRE, their U.S. real estate market outlook for 2024. Marcus Millichap on a video, what to expect for CRE in 2024. Then a piece from Fannie Mae, multifamily values not driven solely by rent growth. Interesting piece on, again, we're looking at what to expect next year in rent growth, but also kind of look back on some of the cap rates. Can you believe if you take the real cap rate on some of the acquisitions that took place in 21-22, negative real cap rates, even as low as negative 4% cap rates? How does that make sense? How do you get a negative cap rate? We'll get there in just a second. You're just going to have to keep watching the video. Make sure that you have subscribed to the Gray Capital YouTube channel if you want to make sure you're getting all the updates on what's going on in the multifamily industry from a handful of multifamily experts. I bought over 10,000 multifamily units. Matt's been involved in the acquisition of a couple thousand as well here at Gray Capital. And every single week, we are breaking it down.
Doggedly following.
Doggedly. So, Matt, you just have been going through all of these different pieces, predictions. We're going to get into the individuals, but sum it up. What is the year to come? I mean, interest rate of Jerome Powell last week, which we can get to our episode last week, which we did right before the Fed's announcement, which we basically were like, we know he's not going to raise rates, or kind of there's a nothing burger. We're not even going to watch it before we record. And all of a sudden he's like, 3 rate decreases in 2024, most likely. So, wow, did we miss that opportunity? But so what's going on? What do you expect for this year?
What was interesting in that one, like when he announced those 3 rate cuts in 2024, I don't think that anyone was thinking that there wouldn't be. Like there are a lot of people in the market were already expecting. He just gave voice.
Well, he's what everyone has said is he said the quiet part out loud. I'm just acknowledging it, as opposed to being like, we all know kind of where things are. Because like we talked about last week, how rents are such a lagging indicator. They know, but he can't say it because that would give the market a green light. The market took it as a huge green light. They were already accelerating. I mean, it was like foot was already on the gas. They just pumped the nitro in there. But at the same time, maybe like a little bit of a delay. It's the questions of, well, why would we be lowering rates? And looking at all these technical factors of saying, well, we'd be lowering rates because we'd be in a recession. Now, we're going to look at some charts and maybe heading in that direction. Or
we lower rates because it's a perfectly soft landing. That's the other.
Exactly. Just perfect and just easing it down, nice and easy. We don't know. How many times has a recession been called over the last couple of years? I mean, it's like a broken clock. It's going to be right at some point. It's a matter of when, not if. Again, the technicals have been wrong multiple times. We're going back to the same textbooks. So I'm not convinced either way. I think it could make sense that we'd have a recession. I could also see that we could have to stretch this out much, longer period of time, like we were talking about. But again, just summarize, just real quick.
Yeah, I'm going to give you
just real quick.
I
give us the
anticipated
breakdown.
This. I've got like a one-line summary of each thing. So I've got,
summarize it, not just I want to what's going to happen in 2024, Matt.
Oh, so I think that it's going to be a little bit better than people think.
Okay.
But so no recession, yes, downturn, and maybe a little bit more rent growth than people think.
So hold on. So you say no recession, but a slowdown. You called it a downturn, but that's facilitating that soft landing, a nice easing into it, and not even like a technical recession, but things are going to slow down, and maybe a little bit of surprise in rent growth. Is that what you said?
Yeah, in the latter half, I think it'll start because it's like an action. They've been low so much, and they've been decelerating so much for so long.
Yeah.
It would be unless the only reason why they would go lower is if it was a huge recession. A lot of what 2024 is dependent on is going to be how the economy falls. And that's true every year, but it just seems particularly up in the air where this economy is going. And before, maybe rent growth could be independent, but it just seems like we're in a little bit of a little more sensitive to greater economic.
That all makes sense. Again, I'm reminded of last year when everyone was penciling in a recession, both in Q4 of 2022, which the last year around this time, where they're okay, now it's going to be in first quarter. Like we're going to be in a recession for sure. Similar degrees of certainty that is surprising.
So I think
those types of calls.
That regardless of what, technically if we are in a recession or not, it's going to feel pretty bad around the middle of the year. And whatever it is, because you've seen how much there was spin on the economic conditions in 2023 when it wasn't really, the numbers weren't saying that it was doing bad, but they had this vibe session or whatever, or the consumer sentiment was not doing well. And I think that it's easy to listen to the negative voices about the economy. And there are all these leading indicators, especially now this is apart from sentiment, but there's all these leading indicators that have said that recession's coming or a downturn's coming. And it has been crazy how much GDP has defied. This is the Conference Board. They have the leading indicators, but GDP has been chugging along at the defiance of these leading indicators for better part of a year.
Yeah.
So I think that, again, it'll be really dark, and that may be the buying time is when we hit these doldrums where asset values do go down because there's real pain that happens, but and at the same time it's going to probably coincide with a lot of pressures that individual multifamily syndicators and owners and borrowers are feeling.
Well, it's the operational performance, positive and negative or good or bad, doesn't always correspond with the market doing good or bad, or cap rates being up or down. And because what I was going to ask you, and then getting into the multifamily and real estate, really just specifically multifamily, is, we're talking about recession right now and a downturn, slowdown, but the stock market has been on a tear, really for the year, but the last month or two. But then once Jerome Powell came out last week and said, hey, rates are going down, I mean, that poured fuel on the fire because that discount, if that idea is the discount rate is going to go down, it's easier to borrow money, deals are going to make more sense. Just monetary policy is going to be looser, maybe not loose, but looser, or the idea that's getting looser, that we've made that pivot. We're going the other direction because the risk was, again, how do we do deals? Like going to real estate, how do you do deals when you don't know where the interest rate's going to be? Now, that's dangerous when the rate's going up, if the trend is going up, because a deal that worked one day, a couple of days later, the rates have moved, the deal doesn't work. But if the rates are going down, it has the opposite effect. All of a sudden the deals are getting better. Yeah. And so what we're seeing in the market is people are realizing that the prices, not on everything, but on a lot of assets have come down from the peak, and they're trading at, 20 to 30% discounts relative to, what they're trading at a couple of years ago, whether that's based on a price per door or on a cap rate. But there's some relative deals. The challenge is the performance right now, because the supply is so weak, that there's a discount on the deals, but the growth, at least the short-term growth, looks it's very mediocre at best. And so from an underwriting perspective, you're putting these deals together, the basis of what you're buying it for seems to be really attractive. It seems like you're getting a good deal, but the returns don't really jump out on the paper, because no one that's trying to come off as somewhat reasonable is going to use any sort of aggressive rent growth, if any rent growth at all. We're going to talk about there's some projections for more negative rent growth next year. If anyone who's ever built a model that has growth that's compounding, a negative number does not, it doesn't help at all. You can't hit the returns that an investor would anticipate with, those kinds of assumptions. And so it's taking an investor to have to step out on the ledge a little bit more, speculate a little bit, which, you're always speculating to a degree, but then there's risk in it of saying, it's not happening today, but rent growth is going to turn around. And it hasn't happened yet, but if interest rates come down, cap rates are going to come down. And so it creates a scenario of where, and this is like just me speaking like personally, like my gut, like sees the trajectory of the next couple of years being really exciting for multifamily investors with some really great returns buying now. But it's really kind of hard to project that on paper. And you have to invest with more than your gut. You got to invest, somewhat empirically. Yeah. Although, I think the best investors probably use a little bit of both.
Well, that's what I was thinking actually when I was trying to measure what the capital markets activity might be, this year. That was one of the big stories of this year, aside from huge apartment supply, was low apartment sales volume. Is that going to change next year?
Yeah.
And I wondered, a part of me thinks that Q1's going to come. There's going to be just a slice of the stock market enthusiasm where people were buying, predicting rates lower. Maybe some multifamily investors are like, well, that makes me kind of want to buy because I think the market's at bottom and I think rates are going to go down, so might as well buy now.
I think you're absolutely correct. I mean, I've just been raising capital for a decent amount of time and through different kind of market situations and different kind of cycles. Yeah. And I mean, comparing last year when the market, beginning of last year, because we often have conversations with investors at the beginning of the year. If you'd like to have a conversation with us, book a meeting, get in touch with myself or Blake Peroni, talk about your goals if you're a accredited investor, kind of the plans for the year, our plans, et cetera. And I remember in 2021, it would be January. It was January 21, and January 22. Yeah, everyone, the stock market had grown, quite a bit, and everyone was excited, ready to go, make some moves, like want to invest in a lot of deals. Then the stock market started really taking a hit and declining, and that mood shifted, quite a bit. Yeah, and then last year in January, we had these conversations. It was much more of a wait and see mentality. And people are saying, well, I had all this extra money I had all these gains from stocks. I didn't sell. Well, now that all those gains have been wiped away, what I was going to sell and use those proceeds to invest, no longer an option. Now people are kind of back in that boat of like, oh, wow, I'm sitting on all these gains. But again, if you're looking at the idea of there might be a recession in a couple months or 6 months, that could change on a dime as well. But the crazy thing is, that's probably going to be the absolute best time to invest. Yeah. Because if there's going to be a bottom, that's when it's going to be. It's going to drag things down even further. So the best deals are going to happen. It's when it's going to look the darkest and the most bleak, but the best time to buy.
And that's what I was wondering, and this is again, it's like an imaginary trajectory, but so people get a little excited in Q1 before a downturn really starts to bite. And there's a little bit of a wave of excited investment, and then things start really going down, and the psychology of a downturn takes effect a little bit more.
People get scared. I mean, people just get scared, nervous, because it's the unknown and how bad could it get. It never gets as bad as people think it's going to be, but
it is super interesting, how volatile. So the stock market will just react to anything, and if they did react to lower rates, if there is a commensurate reaction in the multifamily market, or even in just their attitudes and their plans on investing next year, I just think that it's a lot harder to convince a multifamily investor maybe because their spreadsheets don't work.
Yeah,
and it's a little bit more connected to the setup.
So might not be a bad idea. Sell stocks beginning end of this year, beginning of next year, roll into some multifamily. Yeah, not investing advice, just entertainment. Matt, you want to go to some of these charts that you have? Do you want to go in one right?
I did want to. So, well, it'll help kind of explain my take on the economy, which I'll fly through here really quickly, because I described a little bit about the narrative that I think is going to happen here. And one of the things is, we may have a downturn. It may be even, but I think that the dominant consumer sentiment is going to be that the economy is doing poorly. What we have up here is the difference between it is party affiliation and consumer sentiment. So what did Democrats think when a Republican was president? They didn't think the economy was doing great, and vice versa for Republicans. Right now, Democrats is the president, and Republicans don't think the economy is doing well. That being said, it's
a little bit of a nauseating chart just to be like it's what we know. It's exactly what you would think it would be, but it's just to see and to know that people aren't, not using actual judgment. And it's just, who's in the office. It's their team.
Yeah. They're collecting a bigger paycheck, but then they're going on to describe a bunch of, things that really, really make them mad about the economy.
Just for folks that are listening to the podcast, just so I can describe the chart a little bit, it shows, the consumer sentiment of Democrats, independents, Republicans, and then the average overall. And as you can imagine, when Trump was in office, the Democratic the Democrat consumer sentiment was relatively low, kind of in the 60 to 80% range, while Republicans was like in the 120 range. And then, as the election goes on, it's interesting. The crossover is, it's in November. So it's
right after the election.
Right when basically the day after the election, there's a big crossover, and then consumer sentiment on the Democratic side goes up to, peaks at 100 and then kind of is slowing down around 80 because, things haven't been going that great. But then obviously, as you can imagine, Republican sentiment dropped down really before even the election. It really kind of started at the beginning of the pandemic, which makes sense just because generally the whole world was shut down and everyone was like, well, the WTF, what is happening, even though my guy may be in office. So, if there's a change in the guard, we're going to see it shift, but wow. Yeah.
I think these motivations will only get more aggressive, more persuasive, I guess. And you're going to see a lot more people being persuaded, I think, by a negative view, just because that's getting the headlines, and that's what we've seen in 2023. So,
absolutely.
So I think that this is just going to be a heightened factor that is definitely worth watching next year. Now, another factor is this is job creation.
Yeah.
Now, I said a mild downturn. Well, one of the reasons why I think it might be a downturn instead of like growth or just like stability is there has been a kind of short-term drop in job openings. Right now, we are getting about to the level where it would align with long-term trends outside of the pandemic. But I think we're going to overshoot that, or I guess undershoot it.
Yeah.
In which jobs will be less.
Less jobs.
So I think that the job situation is going to be a little bit worse next year before it gets better and before it reverts to the mean. That being said, there's no one's really raising alarm bells. They're like, well, we're approaching norms, which is true, but you can't ignore the fact that we're going down and things don't just flatten out in a dime. There's usually like a counter reaction, and it kind of bubbles up. And to bring up the other graph that I had is these leading economic indicators are also really well aligned with the expectation of, at the very least, a downturn. There is such a sharp difference between the expectation. Now, just looking at this graph here, this is for our listeners that may not be able to see the graph. You can see how the leading economic indicators, as collected by the Conference Board, the line goes down, and then the line for GDP goes down. There's a pretty strong correlation between these leading indicators that lead the performance of the overall economy, and that's happened in all. You can track it through this progression from 2000 to now is different. The leading economic indicators are plunging down, and real GDP is plugging along. It's not doing amazing, but it's definitely not going down. And it is such a divergence between not only the absolute level of the leading economic indicator and GDP, but just the trajectory. I can't explain it.
And the amount, I guess, the velocity of declines of the LEI leading economic indicator Again, the velocity is, only relative to past recessions. Whether it's the dot-com crash and recession in 2001, the GFC in 08 and 09, or even the pandemic back in good old 2020. I guess we're not as far down as any of those. But they're all at different levels. So I don't know if that says much, but it's not like in the other times where it's gotten even close. I mean, the only other example where it's even, dipped to be negative, and it's negative, 7-ish right now, or wherever that is between, I don't know if it shows the individual number of just trying to interpret the graph, but, back in 2016 or so, it dipped negative for a minute there, but it was, just a little dip below the line. This is a pretty big, shift downward. Can you explain, Matt, what the LEI, the leading
so they do have a breakdown
indicator
part
is
of there is like a financial breakdown, and financial components and non-financial components. The financial ones are, they take the leading credit index, the S&P 500 index of stock prices, and the interest rate spread of 10-year T-bonds less Fed funds rate. And then the non-financial components, a lot of this is average consumer expectations for business conditions, which is kind of subjective sentiment, consumer sentiment kind of stuff, but there is some real concrete measurement.
Building permits.
Building permits.
Hours, manufacturing.
And then like the index of new orders. So there's lots of commercial activity that's tracked here that even if you took apart people's bad feelings about the economy, these indicators would still be negative. I wonder, people are going to study this and see why it's off. Although it's worth noting that the leading economic indicators in every single downturn, those went down far more sharply than the GDP ever went down. So it's a little bit more volatile anyways. It's still surprising how different it is, though. One's going down, the other's going up. It didn't predict it.
And let's just, the shift is that quickly. And, I guess the difference between now and previous periods is, obviously the pandemic, but also, this is the first kind of inflationary period that we've had. And so, some inflation can drive some GDP growth. So I think, it could make sense for the times, but really, really fascinating stuff, Matt. And I'm glad that you brought that to our attention. You want to go back? You want to?
Let's. I kind of want to talk a little bit about capital markets and multifamily. Now, I have two notes for the capital markets. I did describe this small and brief boost in sales activity, maybe in early 24, maybe some hopes, and then it'll get down, and then there may be, following the downturn, there may be less activity. But I wonder, the big question mark here is how much are multifamily owners and borrowers going to be forced to sell? So we may see some of these extensions.
Did you hear, Matt? Did you read about the Lennar?
No, I did not.
Sale. I think it's like 10,000 units or so. I think it's like $4 billion worth of multifamily real estate that they're going to be selling, mostly in the Sun Belt.
Wow.
To raise money. So, it's now, I guess I don't have all the details. I don't necessarily know, have any reason to believe that those properties are distressed. But I mean, the one thing is we should get some serious price discovery and some volume. I mean, that's a good chunk of volume right there. Now, will it all sell? It's got to be broken up. It's just they're intending to sell it, but there is some movement on that front again without much color on.
So interesting how
distressed or not.
Because of the amount of assets that some of these companies hold, one single event, that's just one headline, and you think, oh, it's just an anecdote, but that can have a really it can characterize the market.
Yeah, no, and we know some, REITs are going to be selling some assets at a loss just to kind of deleverage their portfolio, right-size some of their other deals, just do some kind of strategic portfolio repositioning. Again, because if you have a lot of assets, maybe you can afford to sell a couple at a loss, but you still get that cash back and you can pay down some other debt, buy some new rate caps. get a better credit rating, go raise some more money and buy some new deals. And, those losses, okay, maybe it's not that big of a deal if you have a large enough portfolio.
Yeah, I think that makes a lot of sense.
Shouldn't think of it that way.
These pressures are going to continue too, because, rent growth, it may not see that bump, or things may not improve until the year rolls on, until kind of later in the year. So it's going to be continued pressure in Q1 especially, and that, like you said, it may be the darkest when the opportunity comes. So
before the dawn.
Yeah, exactly. and speaking of rent growth, and I'm just going to fly through my prediction for rent growth. I think we get to 2% by the end of the year. We'll go over other predictions, but that's balancing stagnation on the H1 and then a little bit more growth in the second.
Any insights on because obviously real estate's so local, the national numbers, it's like it tells us more than nothing. But the Midwest and the Northeast have been kind of the strong performers this year, with the Sun Belt not doing as hot, especially. Any change to that narrative? I guess.
don't think, at least, and I would.
Is it also supply driven, and the supply's coming online in those same places, or not as much in the same places?
I think even more. I think it's going to exacerbate the differences between places like the Northeast and Midwest, or like the hot markets and non-hot markets. Sunbelt plus Boise, kind of. But like these places that got an enormous amount of new apartments, they're still being built, and it's going to still be distributed in the same top 7 markets or whatever. That it could be an interesting moment where we see some really diverging rent growth trends, at least in the short term, and then no one's going to build there for 10 years, or they'll just keep building. I don't know.
I think some are going to keep building. I've had some conversations with merchant developers recently that are decently well capitalized, and I asked them, I was like, "Are you guys holding off?" And they're like, "Well, we're not actually, on the projects that we already had moving forward, we're going full steam ahead because it's their belief." And which is also, we've echoed this belief also, that they're like, "Hey, look, we're looking to deliver in, mid 25, 26. We think that's going to be a perfect time because no one else is going to be delivering then."
Yeah.
Like, well, that's the second merchant developer that said that. So maybe some other people will. But just what we're looking at from starts and permits, that should really thin out, really in 2025 as we get close to 26.
That's interesting. I was talking to one builder and was like, "Yeah, we build all over the place, and if I had money, I would look into investing in Phoenix." Because
as the builder said
that in almost like, they just got dumped on. They got a bunch of new supply dumped in there, and rent growth is low, so maybe you do get a discount because of the oversupply. For sure. And you ramp it back up.
You're getting big discounts right now. Yeah, it's a good. There's a sales going on right now.
Yeah,
that's just kind of buyer beware. Kind of get what you can get what you pay for. But if you have confidence that we're going to see some growth, we're going to finally see some rent growth at some point again. So maybe you're going to get the timing wrong. Maybe it's next year. Maybe it's 2 years from now. But the general idea of we're going to see some growth at some point because there's going to be supply. So the amount of supply is going to be coming down, and if interest rates are coming down, maybe refinance. Maybe you are able to bring some cash out. And if interest rates come down, cap rates are going to be coming down too. And I guess we're above 5% typically on average, even though a lot of deals are trying to trade around 5%. I can see us, and I think right now I see deals more in the 6% range, or that's where most people think that they should be. Yeah. Not that their deals are still trading sub 5 right now, but I can see us, kind of peaking 6, mid 6s maybe on some deals, and then getting back to that 5% if interest rates behave, and if in that environment, the things look completely different. But it's hard to, you can put it on paper, but it's it's more speculative than your typical.
And that's what I was wondering when I wondered about are multifamily investors as ready to jump in on the possibility of lower rates like the stock market, or do they really need the reality?
Some are.
Man,
yeah,
that's shaky because. And you can correct me, but you put your offer in, and it's still a month or so maybe before you kind of lock in the rates. So you are in a sense kind of trying to predict the future, but that's dicey.
Yeah, it is. Again, you don't want to really be. I mean, you can make a lot of money by timing things, but I've learned that people aren't good at timing things.
Yeah,
it's a way you can be right on the direction.
Yeah.
Like that's not that hard. I mean, that's not always easy, but that's not always difficult. But getting the timing right, it's like,
Yeah.
I think there's more, some people have gotten it right, but a lot of times it's a lot of luck. I know the times that I have timed it right, I take it to more of happenstance and maybe being in the right place, kind of at the right time. I guess we were in the right place, but like the time we can't really take credit for.
Yeah.
But it's tough. There's plenty of things we've timed wrong also.
Sure. So
that's why I don't trade options anymore. I did that for, like a minute, and I was like, this is like not for me. It's too much math, and I am not in it every single second.
Yeah.
Like I am multifamily. Yeah. It's like, I don't understand this well enough.
Now, so having talked about those, and I've read through yours, I was wondering, and a lot of the ideas are cribbed from discussions with you and, through things that you've said, but you've also come up with a set of predictions, and I want to know, is there anything I missed in broad brush, or is there some, kind of nuance or turn? I think that you had a little bit more to say about the kind of capital markets and debt situation that's going to happen next year.
I think I was in kind of a negative mood when I wrote a lot of this. I was rereading through it. I was like, I've got to find some more like positive like takes for the new year, because I think there will be like a silver lining a lot of this, and we're going to see a lot of the pivots and upside, and a lot of this is like just what the stuff that may have to happen before we can really see great opportunities. Probably want to be on the leading edge of it and right before. But, I kind of broke down, I guess, kind of predictions, outlook, things to really look out for. Again, because we don't really know, but just things that I have on top of my mind. I broke it down into kind of industry shifts, some of the fundamentals, and then strategies and tactics to watch, and as well as some known unknowns. And so I'm not going to go through this whole thing, because this is going to be on a blog post or somewhere you can go find it on the internet.
Totally.
You can subscribe to our stuff. Instagram, LinkedIn, go to our website, greatcapitalllc.com. But maybe I'm just going to go over a couple of these, Matt, or if there's any that popped out to you.
I think your lead up, these industry shifts is particularly interesting and really could change how a lot of people are kind of transitioning to.
Yeah, and I don't know. And again, this is just kind of my gut rather than like a lot of insider information. I've had a lot of conversation with industry insiders because like I am one, but other folks, brokerage firms, et cetera. And the first is, the largest of institutional investors are going to step up and consolidate, increase our holdings of multifamily and other housing assets. So I'm talking about, the Blackstones of the world are going to see this opportunity to buy at scale because they've got the cash to do it, the discretionary cash to do it. They're going to see it as a big buying opportunity. They believe in the asset class. They want to continue to allocate to hard assets. And I don't think this is a big leap, but we're already seeing Blackstone, these buyers step in, being aggressive. They're well positioned, they're well capitalized, and there's no reason to believe they're not going to be doing this. And it's a really big way, and it's really a continuing of the trend. Specifically, and we've already seen this happen. Big portfolio in the Austin market. A big institutional group came in with, I think, financing from pension fund, and they basically bought the asset for the loan balance for the senior note. And so basically they're getting basically a 30% discount. Original investors got squeezed out.
Wow.
So I mean, those types of discounts are going to be very attractive to these institutional players if they can buy at scale. I mentioned the Lennar portfolio.
Yeah.
I mean, that's a perfect opportunity for these large groups to come in and buy thousands upon thousands of units at a time, 10,000 units at a time, just one stroke of the pen. They can do it tomorrow without a blink of an eye. It's just not that big of a deal for them. I said they're going to double down on many primary and gateway markets because a lot of those markets are going to see a discount. We're talking about the Phoenixes, like you said, maybe the Charlottes, the Austins. They had conviction behind a lot of those markets before. Yeah, there's some supply, but if they're getting them at a discount, they can have the long-term time horizon to make sense of it. I did have here that they're going to dip their toe into the Midwest finally. I don't think they can ignore the Midwest. I think Chicago is going to be a market that they're really going to go hard in because it's got the liquidity and the scale. They're more familiar with it. But also, I think markets like Columbus, Indianapolis, Kansas City, and St. Louis are all going to be markets that I think that, again, maybe these institutional groups that have been less active in the Midwest are going to start slowly dipping their toe in. We shall see. That's more my intuition rather than really knowing. And then they're obviously going to be looking for opportunistic basis plays in the Sun Belt. Okay. I think that they're going to see some discounts relative to a couple of years ago. They're going to see the long-term migration trends and say these are going to be some great price points and entry points. Yeah. Let's take advantage of it now. Like we weren't wrong that people are moving to Florida. Mm-hmm. Maybe insurance is a little more expensive. Maybe we built a little bit too many apartments, but the long-term trend makes sense, and we're getting a 30% discount. If we thought it made sense, and we're still telling our investors a good idea what we bought 2 years ago for buying at a 30% discount, how can we not say that's a good idea?
Yeah. That's a good point.
So, in the next piece, and not we don't have to go down the whole list, but I think there could be some shakeups in consolidation amongst brokers and lenders. We know, especially some of the publicly traded, brokerage firms. They have not been doing well. Volumes are down, and it could be a huge opportunity for some M&A activity, or some consolidation in some mergers. We'll have to see.
What about secondary lending, like non-bank lending? Is that going to? You think that'll expand, or as interest rates come down, it's going to be less of a big deal?
No, I think it's going to continue to trend that way, especially as maybe some of the more traditional lenders or the agencies are still going to be kind of stuck to how they can lend.
Yeah,
these other lenders are going to be able to step in and be attractive. Although a lot of buyers I see today are still going towards the agencies, but especially in the preferred equity space, the debt fund space, I think that's going to be playing a major role. And I think we're going to see, and this isn't in my notes, maybe it is somewhere, but we're going to see a lot of acquisitions on bridge loans, people being a little bit more taking advantage of the lowering rates and the idea of that we think the rates are going to be much lower in 2 years. Let's just reset that interest rate. In 2 years.
Yep.
HUD financing may come back for similar reasons. You can do rate adjustments during your HUD loan. It's attractive without really paying much money. So that could be something that happens as well. But on the, I'm not going to name any specific brokers or lenders, but I really think that we could see some of that.
That's really interesting. So like some of these big names, some of the places maybe that I get reports from every month.
Yeah.
Wow. Okay.
And maybe even it's some brokers, even buying, or partnering or merging with large lenders also.
Whoa, really? Yeah. Oh, dang. Yeah. I didn't know that.
Oh yeah. So fundamentals, Matt, I did have meaningful distress, especially in the Sun Belt. We're going to see foreclosures at sales of partial or total loss of equity. We will see declining interest rates are going to allow cash flowing deals kind of on the margins are going to be able to refinance. Mm-hmm. So I think a lot of deals are going to be saved that are kind of, again, they're on the margins, but I think the lowering rates are going to help out a lot of folks, but some deals are going to be just too far gone. They're mismanaged. They're just bought way too high price. Those kind of negative real cap rates that we'll talk about in a second. Big surge of preferred equity, other forms of rescue capital, mezzanine debt, a lot of recapitalizations, and again, a lot of non-bank lenders are going to be really prevalent. Mm-hmm. Also, we're going to have some operators and syndicators just get out of the business. Yeah, I think it's going to be it's been difficult to buy. People are going to go under, and people are just going to throw the towel in the ring. Yeah, I just think some people are just going to get out of the business. Banks are going to focus on self-preservation. Not into those details, but you can understand. But I do say sales volume is going to be above average after slow 2023. I think we're going to pick up. I think we're going to see some price discovery halfway through the year. The year I have here, sales will pick up in Q2 rush. It's going to pick up in Q2, and there's going to be a rush by Q4.
Yeah. Oh, yeah.
So relatively slow up until Q2, and then pick up and right there at the end.
Yeah. There is a lot of pent-up investor demand, and that's that's what's like. Well, really, kind of anything could happen.
I know, and that's the thing. It's like things get bad, but like there's so much interest now. People also kind of acting as a herd, and so everyone can be on 1 minute and off the other next. Also, Matt, we mentioned we're going to deliver more apartments than we ever thought throughout 2024. A lot of new supply. Demand's going to be historically normal. Gross absorption will be positive, hopefully, but net absorption will be negative.
Yeah. Yep.
I think there's going to be a relatively short period of deals before dry powder is unleashed. So again, that Q2 period, I think maybe a little bit of that darkness right before the dawn, and then the dawn hits and the dry powder is going to be unleashed. I say cap rates are going to top out at Q3. Again, timing, bad at it, but Q3 cap rates are going to top, may begin to compress by Q4 or early 2025. Yeah. Fundamentals, I think, really short term, very location dependent based on supply. And I think we've got a possibility of a rent growth upside surprise. And you had mentioned, especially if deliveries fall short of their estimates, which they often, not always, do. So those are kind of the fundamentals. Strategies and tactics to watch. What are people going to be doing? The one thing I have on the top here is lease up acquisitions, buying properties that are new construction. They've just been built. They're leasing them up right now. But the situation is these developers, they're on the clock. They're under a construction loan. It's for floating rate. Maybe they're paying 8%, 9%, and they can't put permanent financing on it until they get it fully stabilized 80, 90%. The buyer wants to come in during that lease up project, kind of buy at a little bit of a discount, finish the lease up. You close on a new bridge or construction loan, get it to 90%. You refinance, maybe rates are lower, maybe they're the same, maybe you can cash out, you bought a good asset at a decent discount. Maybe the rents are a little bit lower than you wanted it to, but if the idea is, again, they were renting them out at the rents way below market, that means you can raise rents over time. Yeah. So you're going to, again, your cap rate's going to be kind of artificially low a little bit. So they've been renting out at $1,000 a month when they know, you're going to get $1,500, and maybe if you actually, waited, or maybe the market's soft right now. And so we know we're going to get $1,500 in a year and a half or 2 years, or you're, get a high conviction rate of that.
So maybe even to these lease up, you buy something on lease up, it's 65% full. It's not even all the way full sometimes.
Yeah, exactly.
So it'd be a little more risk too, though. So
a lot of times you'll buy it at certificate of occupancy. So it's like, once you get your certificate, we can go in, start leasing it up. Different, depends on the building. You can go in basically, hey, it hasn't been leased up at all. We're going to take it off your hands. The bigger discount for the leased up it is.
Yeah,
if that makes it.
That's interesting. No, and it's believable because there's so much new supply, and the business of these builders is not necessarily operating.
Construction costs are up, labor is tight, interest rates are up, rents are down, and developers like, look, I just want to be done with this, get my money back, move on. And
they're going to want to take advantage, like you mentioned earlier, of this sweet spot in 2025, 26, where maybe there's not going to be a lot of rent apartments, so that when they're in this lease up situation again, it'll be super easy for them.
Yeah, no, good point. So another strategies and tactics to watch. I have here that centralizing management plans are going to finally materialize for property management. And I feel like 2023, there was a lot of talk and discussion and some early implementations of kind of more centralized management operations, whether that is having kind of scattered site maintenance teams, and you're having like a group of maintenance guys go to different sites, or you're doing kind of centralized leasing, or you're having calls coming to your corporate office or a call center somewhere. And, you're leasing, from one point, and then, you've got maybe less site staff that are focused on tours or whatever. Idea is to be more efficient, save money, costs are up all over the board, margins are thinner than ever. How do we do this, in a better way? And again, it's asking the question, do we need to keep doing the way that we've been doing things for decades in the multifamily business, just because that's the way we've been doing it? Is there a better way with technology, with using the internet and things like that? Do a lot.
So instead of like these, instead of the leasing agents, let's use Forest Ridge, for example. Instead of like a Forest Ridge person for Forest Ridge, you are the leasing agents. You're going to give the tours. You're going to answer the phone calls. That's your job. You are at that property. Instead of one person there, it could be maybe this guy does all of the calls.
I'm going to turn this example out. Because you used a really good example, just not in the right place. Because Forest Ridge doesn't have any on-site personnel.
I thought of that when I said, I was like,
but we use it. I wouldn't call it full centralization, but it's like full centralization is like the leasing person is like maybe here in our corporate office in Indianapolis, but this property's down in Bloomington, Indiana. I was just there earlier today, and but we lease out another property. The leasing agent is based out of Echo Park.
Okay.
And our maintenance team is based out of Echo Park. So we have, kind of our management team based out of one property. It's a larger property, has more like resources and facilities. But then we have teams from that property that we send over to Forest Ridge, which is like a neighboring property. It's not an immediate neighbor. It's just kind of a couple miles down the road. But so like when we have a tour, our leasing agent goes over to that property and does a tour. If we have a work order, that maintenance person from Echo Park, will go over there, and typically we try to batch it to make it efficient. But that way we don't have people, just that are sitting over at Forest Ridge waiting for things to do. Where it's like, how many tours do you usually give a week? Well, it's usually less than like a dozen. Maybe it's just a couple. So do you need someone physically on site to do tours if you're only doing a handful a week?
Yeah.
Probably not. And so you need someone to do the tours if you want a tour. There's also virtual tours. There's self-guided tours. There's a lot of different options. But it's, do we need a physical person in a chair in that office for a long period of time? And if there's, so how much work is there to do? Can we split it across multiple properties? Anyway, so that's the theory, and it's been theorized a lot. And if you went to any kind of operations conferences or talked about property management, centralization was what everyone was talking about. Again, driven by high payroll, high expenses, and the advancement of technology, where it's really possible now.
Yeah.
We're going to see those plans be implemented as budgets for 2024 have now been finalized and are going to be implemented in 2024, rolling out that new technology. There's going to be some delays because you need some maybe staffing attrition. People will just lay their folks off.
It would also seem like you would need some kind of number crunching on how to make sure that the needs of each unit, the needs of each property is met by either like the leasing agent or the maintenance person. Like if you're off on that prediction and you actually have one maintenance guy less than you need, then that could be a problem. And the guarantee is you spend more money, you have a guy there all the time.
Yeah.
But if he's not working 2 days of the week, all told, then that may not make sense.
Yeah, and there's no silver bullet to property management. Every site and company is a little bit different. But I think we're going to see that really develop. It's not going to be like done, but I think it's going to start to take form. We've got some talking about distress. It's going to come in a variety of flavors. Most of the real distress will be pre-1980s kind of failed value add deals, but that's going to be the stuff that the least amount of people are going to be interested in.
Yeah,
I mean, the smoking hot deals are going to be what nobody wants. Maybe for some good reason. There will be, I believe there's going to be a relative basis floor on stabilized B and A class deals. What I mean by that is like there are so many people who want to buy those deals that the prices are only going to get so low. I think they're a little low. They're low right now. They could get a little bit lower, but they're not going to like get so low just because people want to invest in multifamily and they like it.
Yeah.
And they've been investors, so they know relative
totally
what the cost basis is. AI. Oh, I mentioned bridge loans for acquisition. We'll see a resurgence. AI, artificial intelligence, will be. I said will be discussed more than it is implemented.
Yep.
Right.
We covered it last week.
Yeah, exactly. The Midwest. And I'm biased writing this, but it's the truth. It's the truth. The Midwest will be in the spotlight for the first time due to relatively strong performance and fundamentals as owners burnt by the bust in the Sun Belt.
It will either be like. That could be true, but they could also double down. Like,
no. Oh, I didn't say necessarily that people will like switch to the Midwest. I'm just saying that like it's gonna have we're gonna have our moment in the starlight. 15 minutes of fame. And people are going to be burned by the Sun Belt, but then they're going to double in the Sun Belt, which might not be a bad idea. I'm not.
It's interesting, and it may convince some people because it would be essentially 2 straight years of Midwest outperformance. Yeah. And like, how many years do things need to outperform before kind of competition comes in?
Yeah, maybe one more. I don't know.
Yeah.
Midwest domination. I just you wouldn't think because people were like, "What's going on in the Midwest?" I had have conversations with people who are like, "What do people do in the Midwest? I don't know. What do people live there?" And maybe it's not for you then. I get it. It's like, global warming. It's going to be a great place to live in a couple decades. This is like, it's a new Sun Belt. Are you kidding me? We're in like a great spot. Like, regardless, you believe it or, Anyway, not to go down anything like that. Okay, known unknowns. I love this. Banks and lenders' willingness and ability to modify loans and extend and pretend. Currently, lenders are doing their best to work with borrowers and modify deals to make it all work and avoid distress, but volumes may reach a point where that's just unworkable. They can't work with everybody. They just don't have the option, whether it's from regulators, whether it's just, again, it's the volume. So what we're saying here is, like, we know it could be an issue, but, like, it could be, the can could be effectively kicked down the road. The ability of can kicking is questionable and may not be an option if someone just grabs the can and shoves it down everybody's throat. Like, you can't kick it at that point. Maybe you don't have a choice. Is that the
I'm there. I think that's totally true. I'm thinking like, well, if it's an economic downturn, that's going to probably making it harder for them.
There's not more liquidity.
Yeah.
Until there is. And then there's like an unlimited amount.
With timing.
Get ready for that.
Yeah.
The possibility of recession is not zero, as we've talked about many times, and some indicators, such as what we looked at just today, say that it's even likely next year. So get ready for that. Also, get ready for not having.
Don't worry, it's gonna feel bad. No matter what it is, it's gonna feel.
It's gonna feel uncomfortable. Rising unemployment will pour cool water on a smoldering housing market dealing with historic supply increases. It goes to show the recession is going to make things good. It's going to make things really dark before the dawn.
Yep.
The next thing, the future of revenue management. These lawsuits against RealPage.
Yeah.
I personally don't think they're going anywhere. Could they be settled in the Supreme Court elsewhere? Are they going to be probably these companies are going to settle, and I think they're just going to change their algorithms just to like avoid getting close to a perception of having some sort of price collusion scheme. I really think though that there's more being made of it than really exists, and if they're price fixing or colluding, then there's a lot of industries that need to have a talking to just because they're using technology and pricing information.
Yeah.
We'll say that's another episode. Politics in the 2024 election, everyone's favorite subject for the holidays. November 2024 presidential election may bring interest rates down further because, need that Biden economy.
They'll try.
Something they're going to try, even though, housing, specifically affordable and private equity ownership. Affordable housing and private equity ownership may be hot button issues. I have a sense of it, Matt, big time, that it's going to be. Could add additional uncertainty for future regulatory tax implications. I didn't write this, but I don't think anything's ever actually going to happen to it. There's going to be a lot of conversations of Blackstone, I'm going to say, I said it incorrect. I meant to say it incorrectly. BlackRock buying up all the housing, even though BlackRock doesn't buy any housing.
Yeah.
And people don't understand what they're talking about. They don't understand housing. They don't understand economics or business, but they're going to regulate it. But it's going to sound really great politically.
I think institutional investing in single family homes has gone down relatively, but investment in single family homes, investor homes, there was an article I read recently, has been going up. I think it's because of interest rates and, I'll rent this house out or something like that. And there, that may be kind of I don't know. I feel like that could be part of it is not, these are mom and pop people or single, or an individual person that is maybe renting out their bigger house instead of downsizing, they're renting out part of it or I feel like there are more homes taking on this investment function for people. There's a larger discussion of ADUs and accessory dwelling units, but ultimately it is not the institutional investors, because they tend to invest when rent growth is at the top and they see it go down below. So they're not buying up neighborhoods though.
Well, yeah, and it's just obviously the issue. It's been blown way out of proportion. I mean, Blackstone is not buying up all the single family homes. Like, our institutional investors buying up a decent amount of homes in real estate. Like, yes, but like specifically single family homes, I mean, it's not enough. It's not moving markets the way people are.
If one company bought up the entire residential block or an entire neighborhood of single family homes, I would start to worry, but I don't think that's ever going to happen.
And what's wrong with that?
Well, that's probably. I mean, what is it? Communist to make the thing. But I think of it in the same way
between build to rent. Buying out a subdivision.
Yeah, that's true. I think of it as in the same way as this lawsuits against RealPage. If they had local control over the price of housing in a large enough area, one entity, and I'm not even talking about RealPage as the purveyor of this information. I'm more talking about like a single landlord being able to fix prices over like a huge block, not even more than a block, but this large neighborhood area, this section of town, that does seem a little anti-competitive.
Yeah. Okay. So he's keeping the rent high. And so, but how is he? Are they raising a barrier to entry? Can no one else build housing?
Well, because this is my imaginary scenario. Okay. He owns all of the housing.
So it's like a what's the movie about the train? That's like an allegory to.
Oh yeah, yeah. The frozen train. Yeah.
That's not what it's called.
Bullet train. What is it? Ice something. Well, yes, it's a bullet train in the ice. Yeah.
Look it up real quick so we can talk about it.
Yeah. Let me make a note.
It's like something weird.
Snowpiercer.
Okay.
Yeah.
So it's like that movie Snowpiercer, where it's like the whole, the world's frozen and it's just this train, and so it's like you're kind of on it's like in a vacuum. It's like there's nowhere else to go, and it's like they own. If in your world they own.
Yeah, you hear that?
The Snowpiercing train. Is that the Snowpiercer?
I think it's coming along. But it's all made up in like I can already, even as I come up with that hypothetical, I can think of counter arguments. Well, why don't people just live somewhere else? And if someone owned a bunch. If they did own every single piece of housing in a neighborhood and they jacked up rents, people would move out. And so there's always
someone would be like, wow, they're getting all this rent, but I can build something. They're charging $2,000. I'm going to charge $1,800 and undercut their business.
Yeah, I'll go right to the borderline, and then people move in there.
Who isn't going to go to the $1,800?
Yeah.
So, and that's how it's supposed to work. And again, it's not like an industry where it's like no one else can build houses now. You could argue that if the municipality's not issuing any permits, not allowing any building, that could be the case. Okay, just to wrap this up, and maybe we really kind of have just last couple of geopolitical. No one's coming here for geopolitical information, Matt. But a further deterioration. This is like you all know this. A further deterioration of relations in the Middle East or Ukraine could lead to broader regional conflicts, of most affecting energy prices, which. Really pay attention to energy prices, inflation and market volatility, alternatively a resolution of hostilities in the Middle East or Ukraine.
Yeah,
that could be a positive sign for markets and inflation.
I was thinking a little bit about inflation and core inflation and the difference in stuff and how energy prices look like they would be. It's almost like set to increase because gas prices have been so low lately, and it feels like nowhere to go.
You heard this whole Suez Canal
with
rodeo?
BP, and BP can't get their tankers through.
I think the Suez Canal is going to be. They're shipping everything around the Horn of Africa.
Yeah.
And there's a big task force because the Houthi rebels are, taking over tankers and cargo ships and whatnot. But I mean, like we have a model. We have not just an analog. We have an example of the Suez. Like, do we all remember when the ship was stuck in the canal?
Yeah. Oh,
we already shut it down once. That just the frickin' the boat in the canal. Created all this. I mean, that was like blamed.
Yeah.
Legitimately blamed for. And so, like, we're basically doing the same thing, but now we've got these like big super tankers.
Yeah.
Which
well, either way, even apart from
I'm
that,
not a Suez Canal expert.
Gas prices have been so low lately.
Yeah.
And the fact that like it seems like they had nowhere else to go but up.
Yeah.
And that's probably going to have a big effect on people's perception of inflation. And at the very least, gas prices, that's going to affect real inflation. And core inflation right now is about 4% compared to the around 3% for, all items inflation. So it may feel worse than it is. I don't know.
Yeah. Well, Matt, we've got some, we've got some reports to cover.
Yeah. I'll go as quick as I can.
Let's do it. Let's do it with grace and style.
Yeah.
So where would you like to begin?
So we can start here at the Marcus and Millichap. It's a little bit broader than a couple of the other outlooks that I have here recorded. All right, yeah. So this video, it's a nice overview. Pretty quick, covers industrial and retail and office, but I'm most interested, obviously, in multifamily. Also gives a lot of economic context, basically beginning with their assumption that their baseline scenario is a soft landing, and a soft landing which also includes a downturn. So they're saying that job creation is going to trend lower towards historical average and wage growth is going to slow. But he does think that there's going to be increasing improvements in consumer sentiment, which I disagree with. I think their voices will be loud and those voices will be saying that the economy is bad. But you can look at the numbers if you want to find out.
But next year, not. But it seems like today, a lot of those the naysayers are less quiet.
Yeah, I know, and they're just going to
immediately.
They're going to get louder and louder.
Yeah.
And he also talked about home buying still going to be more expensive than renting, so that's going to support the apartment market. And for multifamily specifically, they have apartment demand. So net absorption will be 390,000 units, but they are expecting 480,000 in new apartment supply. So vacancy expected to be 6% and rent growth at 1.5% for the year.
1.5. Now, just in context, Marcus and Millichap's projection for rent growth for 2023 was 3%. So missed that by a little bit. So
more modest.
I think that they're trying to be a little bit more modest and acknowledging that, like, look, we're not going to see the gangbuster year by any means. We're seeing below average growth, half of what is typically seen on average.
So Marcus and Millichap's 1.5, CoStar is 3.7, and ultimately
CoStar is 3.7.
Yeah.
Yep. And then we're going to be fast forwarding here, but just since we're talking about these rent growth projections, Cushman & Wakefield.
Let's dive into Cushman & Wakefield because
dive right into C&W.
Yeah. Their ultimate story in that, just to finish up on the Marcus and Millichap, is the economy is going to be a little bit slower and CRE markets may follow that, almost suggesting that there may be a bigger opportunity for investors that want to time it perfectly, time this downturn and get that pricing right. We covered Cushman & Wakefield last week, but there was a piece that we did not cover in their reporting and forecasting on the multifamily market specifically. And they mentioned in their forecast that new supply is expected to crest in early 2024. That's fine. They are expecting 400,000 new units, far less than 480, but still there. The real headline here is their expectation for rent growth. 2024 rent growth, according to the projections from Cushman & Wakefield, is negative 2.5%.
Well,
I think that's striking. No matter how you put it, no matter what your assumptions are for recession or not recession, a negative 2.5% coming off a year that maybe a flat 0 for rent growth is striking in that it's going to be outside a really huge. If there's a recession and it's not going to be huge, I feel like that negative 2.5 is like, well, only if there's a huge recession.
I wonder if there, and I don't think this is the case. Cushman & Wakefield, I think, has at least their stock price. Mm-hmm. I think they have more debt than most other brokerage firms at the national level, and their stock price has not been doing that great. I'm just always curious if one's projections on the economy at all reflect of what's going on in their own economy.
It has to, for sure.
Of like, man, our volumes are down, we're not making so much money, things aren't going well for us. The economy's not good.
Yeah,
doesn't feel good.
Yeah,
I wonder if that seeps in. Now, obviously, if from their economists, which they are, and trying to be objective, which I believe that they are certainly looking at being. And also, compared to typically, they're going to say there's going to be more rent growth because they're trying to sell apartments. Mm-hmm. I think it all kind of makes sense that they may even give a kind of a realistic assumption, maybe with even a slightly more negative hint than they typically would.
And they give that negative 2.5 number in their report, and they kind of just keep going after it. They don't dwell on it at all. In any other report, that would be a kind of a headline.
Yeah.
But that's interesting just to note from Cushman & Wakefield. Now, CBRE, their predictions, now I have them written down here somewhere, similar economic predictions, but for their apartment predictions, their rent growth is 1.2%. So we have, just to review, Marcus and Millichap, they predict 1.5%. CoStar predicts 3.7%. Cushman & Wakefield predict negative 2.5%. And CBRE predicts 1.2% rent growth in 2024. And Matt Bosnagle predicts 2% rent growth in 2024.
2%.
Yeah. It's probably not an average of all those figures, but it's well within. And this really doesn't illustrate they're not really converging on a common figure. It may be around 1 to 2, but like one person says negative 2.5, and another person says 3.7. That's a big gap.
Yeah, it's a big spread. Especially when last year everyone was like on the same page of 3%, which was kind of
everyone,
like a little bit of a softball choice.
But in CBRE, they do converge. So CBRE has 440,000 new units expected, and so they're all kind of falling in there, and they're all predicting about 94% occupancy, essentially. in that range. And I think the key here is going to be, like I said, what is the economy going to do to all of these predictions, and if it's a downturn or if it's a severe recession or something nastier. The other forecast was part of a Fannie Mae report. Now, it wasn't a traditional report. I just used it as a forecast. They do have some expectations that they build there, so I'm counting it as a forecast that we can include alongside the other ones. But yeah, that's about multifamily values, not driven solely by rent growth. And I was hoping that you could help kind of explain in general what these other factors are, or maybe kind of what they're getting at, because yeah, it's true. Rent growth alone doesn't explain multifamily values, but they set up this comparison of multifamily rent and I'm sorry, not multifamily rent, multifamily cap rates, and they compare it to inflation, and they show for a significant period of time there is negative real rates if you adjust for inflation. And my confusion here is that, okay, yeah, if you take cap rates minus the inflation rate, sure, there's a point from May 2021 to February 2023 where those cap rates were negative if you subtract the inflation from the nominal cap rate. But I feel like a lot of the people buying that at those low cap rates were buying because inflation, yeah, it makes things expensive, but it also kind of is associated with rent growth. So I don't know if that is a good counter argument or if these people were really chasing down and really in a fervor.
Yeah, the difference is, yeah, there was an incredible amount of rent growth at the time, which made up for the low cap rates. Now, adjusting, so what they're doing is they're taking the cap rate at acquisition, and then they're subtracting inflation, just like we would look at like real interest rates, inflation adjusted interest rates. The buyers of these assets are saying, well, now they would never say we're buying at a negative 4% cap rate, but they're saying, yeah, well, we can buy at a cap rate, or we don't really care as much about the cap rate because of all the growth that we're going to see because of not only the market growth, or we're going to do a value add plan. But what ended up, that did happen maybe in some cases. They got some really good growth, but what happened in some other cases is that they saw a couple units were being rented for that huge rent increase, 20, 30%, maybe a good chunk, maybe 30, 40, maybe 50% of the units. But then the market started softening and expenses went up considerably, and then all of a sudden they couldn't not just get any rent growth. It was they were looking at rent declines. They were looking at their renewals actually being less than way less than their market rent, and then their market rent was less than some of their renewals. So they kind of had an inverted renewals to lease spread. And again, as expenses continued to rise, all of a sudden really was flipped upside down. And so whether you thought that you're going to get that growth, again, it's not like it was completely without basis or merit, but it's not a guarantee. Yeah. And so some people didn't get the rent growth, and so they are stuck at essentially kind of a negative cap rate. I'm not just talking about negative leverage, positive leverage, but not in meaning that your cap rate is higher than your interest rate, but man, this is incredible.
Yeah. That's what I kind of got.
And that's how crazy things got. That's the peak greed right there.
And that's what I was wondering. It's like the people that got on the other side of this, really, they saw the rent growth that was not guaranteed, but it seemed like the expense growth really was maybe guaranteed. Now that leaves a lot of details out of the picture there, but it is interesting to see how much and how associated it was with interest rates too. I'm sure that these low cap rates were also because financing was super easy to get, but we're still very low if you're adjusting for inflation. We're well below what the real cap rate should be if you're comparing to historical averages. So I think apartments are still pretty expensive.
The money was free at the time, and so people were allowed to pay prices that didn't make any sense. Yeah. And now that the money costs quite a bit, it's just a different story.
Yeah. And
our lighting's a little bit better, Matt.
Oh, I know.
The sun has gone down. That's why I was standing up there.
This is golden hour. Nice.
Golden hour.
And so their kind of closing comments, or at least their forecasty, they make a move towards what might happen in the future. And they say that we believe multifamily property investment trends will see a longer hold period over the next few years, since property price appreciation trends have been moderating and are expected to do so with interest rates staying higher for longer. They think that the 10-year will stay above 4.5 through 2025. Oh, I'm sorry, not the. Yeah, they say that's the 10-year will remain above 4.5 through 2025, and inflation will stay above the Fed's 2% target during that same time frame. So
are they already wrong, or are they just?
It does seem like they may already be wrong now. Maybe things may.
The 10-year is below.
You know what's interesting about some of these reports? They were written, a quarter ago sometimes.
I know,
and things change quickly.
They change quickly, and if you're going to be writing predictions, I mean that's just what's going to.
Yeah, that's why
I'm going to get it all right.
I very much though respect the people that don't beat around the bush. They're willing to give their number. This is what will happen. And that CBRE report had great things like this will happen and this will happen. It was like, well, that's refreshing, because I would hedge a little bit more.
Some bold. Yeah, I know. Being like, I don't really know. Some bold calls. It's not a holiday or anything today on this Tuesday. 3.931 on the 10-year Treasury. I mean, but again, just looking at me, we brushed 5%. Whoop, nope, don't go over that 5%. Just right there. We don't want to get too crazy. Oh, wow, all the way down to 3.93, man. We're living in a different world now. Again, it seems like so low. Basically, we're back to basically July of 2023, which in July, again, it's like we're having this conversation. Everyone's like, man, the rates have come down so much. All the deals are making sense, and the prices have come down. So the deals probably are making some more sense in some cases, but not in all, because it's not like back in July we were like, man, it's a great opportunity to buy. I mean, the entire time when the 10-year Treasury was in this range, the deals weren't out. Like no. The deals were
even when they were like 3.5 to 4, that was still.
Yeah, that's what. And that's what. I mean, when did we write our first report on loan maturities, Matt?
That was in June.
That was the first one. So June. So right around like a similar time period. And the analysis then was, look, like if interest rates stay the same, like interest rates are going to have to come down quite a bit from where they are today for it to work. And they may just stay as high as they are today. We weren't even saying that they're going to go up more. They're just like, they may stay, as high as they are today. And today, the deals on the refinances don't really work. Yeah. But now, again, when things up with the 5%, then it was like, all right, it's just, we're done. This is it. Now we're back to 3.9%. It feels a lot better. And most likely going to keep going down, but we got a bumpy ride. Yeah,
I agree. And I think that it's going to be hard to make predictions on where things go. I like to think that a lot more people are ready to get a little bit more aggressive than they were last year, though.
I think so. Because again, what I was talking about, you're going to have to maybe go out on a limb a little bit and say, it's not going to look great this year or next year, but if we want to take advantage of the growth with this price, if we want to wait till the growth happens, you're going to be paying up for the growth. Yeah. So the returns are still not going to look attractive.
And that's what is kind of interesting about the Fannie Mae and even really the Marcus and Millichap, these broad brush looks at CRE. If you kind of take the assumption of where everything is and what might happen in the economy, they're like, well, things could. I mean, if you look at it just at a glance, the property values are going to go down. CRE property values are going to go down. That may be the dominant story for the first half. Yeah. Until the fervor starts. Yeah. We can only hope that the fervor starts, and I'm going to be there. I'm going to be there to follow it.
It's going to be like stumbling on an ether binge, buying multifamily or something.
That's right.
You never know. Las Vegas, crazy market. Anyway, so Matt, this is great. This is awesome. Looking at the crystal ball, trying to see through. I'm sure some more of these are going to pop up. Be looking out for our own publication of, what we think is going to go on. I'm going to refine this a little bit. I want to talk to you about it, Matt, though, with all of our friends and listeners on the Gray Report. Yeah. Wishing everybody who's listening, has been a subscriber, very happy holidays, Merry Christmas, Happy New Year, Boxing Day.
Oh, yeah.
I don't know the right Kwanzaa.
We'll be there before New Year's, though, so we'll be
okay. Yeah, we've got an episode next week that we're working on. We never sleep. Matt, there's never been a Gray Report episode. I mean, have we ever missed a week? I mean, I
don't think so, no.
have missed a couple weeks. Addison has sat in my stead.
We've had a stable of
For how long? Do you know what episode this is? We need to have the episode count.
no, maybe
We're in the
120 maybe.
120.
Yeah.
Wow, that's good stuff. I think sounds about right.
Yeah, more than a couple years.
We're in the hundreds. We're in the 3-digit club. Everyone have a great time. Make sure you subscribe to the Gray Capital YouTube channel if you are not. If you are an accredited investor, you want to see what Gray Capital has coming up. We're looking at some deals right now. Some pref equity deals, really looking good. Some solid real estate with some great returns, risk adjusted. It's like, why would you do anything else? I don't know until you find the real deal that's going to. Anyway, there's all kinds of opportunities happening now that we're taking advantage of because of our unique positioning. And we're seeing a lot of interesting opportunities for 2024. Like I mentioned earlier, if you want to kind of get ahead of the rest of the game, go on over to graycapitalllc.com, schedule a meeting with one of our team members, either myself, Blake Perrone, Griffin Haddad. Let's have a conversation, just start doing some planning for 2024. You can talk to us about what we're thinking about, how we're seeing in the market. And we shoot you straight. We're going to tell you exactly what we're thinking about, what we're seeing, and if it's a good fit for us to work together or not. We're just going to learn a little about the market, do some good networking. So get in touch with us. We are scheduling meetings kind of all through January to help folks plan for the coming year 2024. Because like we've talked about, there's going to be some dislocations. There's going to be some opportunities, and we want to be in the best position to take advantage of it. Once the opportunities are here, you can't then decide I want to get into it. It's going to have to be before. And again, it's we're buying the rumor, selling the news. Maybe we don't sell. Maybe we're going to buy the rumor and refinance the news. Is what we're going to do because we have to buy at the good basis before the growth shows up.
Yeah.
And again, so it's kind of like the rumor that the growth is going to be there and the returns are going to be high. So it's going to look a little bit different than some of our past deals where it's just been a more stable market, where it's going to be a little bit more tactical. Again, we can't really time anything, but we can use our judgment based on relative values and do some good risk mitigation and make some good acquisitions. Yeah. So get ready. And again, it's not, you want to get in the front of the line. Once we have the deal, if it's the first time having a conversation with us, typically what happens is, very rarely, it's like the first call. Someone's like, yeah, I'm going to write you the check. Typically, it's like, we want to get to know you. We want to get to know you. You want to get to know us. Yep. Typically, like 2 calls, usually maybe 3. Some emails, exchanging information before someone's made a decision. That can take like a couple of weeks. A lot of our deals, Matt, they go within a week, 2 weeks, especially like on the pref equity deals. We've got some larger groups that want to take the whole thing. Typically what we're trying to do is like reserve a slice for our smaller investors, our awesome group of individuals that are investing, 100, 400, maybe $500,000 up to $1 million at a time. But, we're going to basically have a big chunk for our institutional investors. And then we're going to say, hey, here's a chunk for all our individuals. But it's going to be first come, first serve. Yeah. So it's going to have to be movement. Anyway, accredited investors only, 506C all day long. We hate you, the SEC, but we don't want to be on your bad side. Anyway, everyone have a Merry Christmas.
Yeah.
SEC they don't work during Christmas. We're good. Okay. All right.